welcome to MF Primer. I'm Lisa, and the word we are going with today, the MF jargon that we're going to tell you a little bit more about, is expense ratio. Now, if you're a stock trader who uses various financial ratios to select your stocks, you may already think that you know what an expense ratio means. After all, it is a financial term. But unlike financial ratios used for selecting stocks, although expense ratio is also used for selecting mutual fund schemes, it is not that complicated. An expense ratio simply is the annual cost of investing in a mutual fund scheme. Or in other words, it is the cost or the expense you pay to make an investment in a mutual fund scheme. अब अगर आप इन्वेस्टमेंट कर रहे हैं तो उसका कॉस्ट भी तो पता होना चाहिए. So here's the thing, it is not focused on enough. When we are choosing mutual funds, we're just looking at returns, which is not a wrong thing to do. However, you should be aware of the expense ratio of the scheme because your returns are shown only after the expense ratio is deducted. मतलब आपका जो गेन है म्यूचुअल फंड में वो एक्सपेंसेस के बाद ही होता है. तो अगर एक्सपेंस बहुत ज़्यादा है स्कीम का तो मतलब आपका नेट रिटर्न जो है वो थोड़ा कम है. So let's understand this a little better. And to do that, I just want to go through 4 important things about expense ratios with you today. The first thing is that active funds have a higher expense as compared to passive funds. Active funds are funds which are managed by individual fund managers, and passive funds are things like ETFs and index funds. We have discussed this before, and you can find those videos right here on FIRE's Mutual Fund channel. An actively managed mutual fund scheme, especially in the equity space, can have an annual cost of anywhere between 1% to say around 2.5%, whereas an ETF will have a cost of only 15 basis points or lower. When I say 15 basis points, I mean 15 paisa in 100 rupees. When I say 1%, I mean 1 rupee in 100 rupees. So you can see the difference. However, cost is not a reason to choose one fund over the other. It is a supporting factor. So you have to look at a lot of other things. And also understand that the cost is not deducted upfront. जैसे इंश्योरेंस में होता है कि जो भी कॉस्ट हैं वो प्रीमियम में अपफ्रंट निकाल लिए जाते हैं, उसके बाद जो बचता है वो यूलिप के केस में वो इन्वेस्ट किया जाता है. म्यूचुअल फंड में इट इज नॉट डन दैट वे. इट इज एडजस्टेड इन द डेली NAV or the daily price of the scheme, and for whatever period you are invested in the scheme, that is the period that the expense is valid to you, and that is how much you pay proportionately. Okay, so that's one thing. Now the second thing that I would like to talk to you about in this regard is direct plans versus regular plans. Let me explain it this way. Every mutual fund scheme has 2 alternatives. You can invest through direct plans or you can invest through regular plans. Direct plans assume that you are not taking the help of a distributor or an advisor, whereas in the regular plan, it is assumed that you are using the services of a distributor or an advisor to help you or to guide you in selecting which fund to invest in. And for those services that the distributor or the advisors provide, the mutual fund or the asset manager will pay them a commission, and that commission is embedded in the annual cost that you pay as an investor for investing in the scheme. The direct plan, which assumes that you don't use the services of anyone else, but you choose the scheme yourself, does not have that additional cost of the commission which is paid to the distributor, because you're doing the selection yourself. And direct plans are what you can actually buy on FIRE's Direct. So that is the difference. Direct plans do not have the added expense of commissions paid to distributors or advisors. Now, in the equity space, your direct plan expense ratios can be, lower than the regular plans by as much as, say, 1%. So you could save cost, provided you know what you're doing and you know the funds that you're buying and you're quite sure about that. Also, this is applicable on debt funds as well. You have direct plans in debt funds and you have regular plans in debt funds as well. And there the difference will be, slightly lower. The other thing you have to be mindful of that is even within the direct plan space, every scheme will have a different annual cost. So it's not like, all direct funds will have a standardized cost. No, every scheme will have a different cost. And even there, the difference can be, as high as even 1%. It could be as low as 20 basis points, but it can be pretty high as well. So you need to check your direct plan expense relative to other funds and other schemes in the category as well to see whether you are paying high or low. Okay, so the third thing I want to talk about is that debt funds usually have a lower expense ratio as compared to equity schemes. And the lowest expense ratio is found in the very low risk debt funds like liquid funds, overnight funds, ultra short term funds. Those have the lowest expense ratio because the risk is low and you're managing, securities which are say 30 days from expiry or 60 days from expiry or even lesser. Overnight funds will have the lowest expense. So in debt category, generally the expense will be lower than equities, but lower the risk of the scheme, even lower will be the expense ratio. So that you have to be a little aware of. But again, there is a huge variance from 5 basis to 1% within a debt category. So you must check relative to return what is the expense ratio and only then be sure that you are getting something which is optimizing your return and not eating into your return. The cost or the expense is not eating into your return. The last thing that I want to talk about is that expense ratios are not random. Okay, so far I've been saying that there is a lot of variance, which is there, but it is not random. The market regulator SEBI has prescribed the calculation for the expense ratio. So mutual fund houses have to pretty much stick to that. So there is a formula driven expense ratio and there is an upper limit. For equity mutual fund schemes, the upper limit is 2.25%. And for debt schemes, the upper limit, or rather any other schemes other than equity, the upper limit is 2%. So within that, funds can charge you an expense. Also, what you must remember is that larger the size of the scheme, lower will be its expense ratio as prescribed by the regulator. So, it doesn't mean that a large fund house or a large scheme will necessarily be a better performer because its cost is lower. But just know that the cost will be lower. So if it is a good performing scheme or two schemes which perform equally, then a larger sized one will have a slight edge because the expenses are lower and hence the net return will be higher. But you must be aware, check. Sometimes what happens is that smaller size schemes, the performance is so good that the difference in the expense ratio is covered many times over thanks to the much better performance. So ultimately, yes, what the fund is performing, how the fund is performing is the most important thing. However, expenses eat into your performance, hence you should be aware. So now with all this information on mutual fund expense ratio, you are better equipped, better informed to know the cost of your investment and to make wiser choices. Do stay tuned to MF Primer for more such explanations on all the jargon in mutual fund schemes. Thank you for watching. I'm Lisa.